So, all right, let's get to the what everybody wants to talk about.
Election.
Yeah, we're not going to talk politics. Well, we'll talk political parties, but we're going to specifically talk about how the market reacts, and we have a couple slides here that I think will be interesting. Um, so this one is going back to the 20s. So this is actually using the Dow. So all of these really long terms use the Dow, showing the average return, right, which is in that little gray at the bottom where it's circled. You can see that red circle. Average return of the market in an election year is 7.5%. And then you can see typically the best year is the year before the election, average return of close to 14%. We don't know what the market's going to finish the year at. Last year we did have a great year, so this is probably going to hold true that last year, the year before the election year, was the best out of the four. Typically, the worst year is 2 years after the election year. Average of only a 3.3% return and only up about half the time. Right. So think about like, I guess, coming out of right after midterms is typically the worst year. Percentage of time stocks rose, again, typically best the year before of the election and the year of the election. Over 3/4 of the time in both cases, the market is up. So looking for any correlation just in terms of election cycle, this is it. And thus far the trend is remaining true. I think it is interesting to say, to look at this. If you look at it from an election cycle, at all times, it's always more than 50%, no matter what year you're in. Right? The market's typically up over half the time, no matter what year of the election cycle you're in. So just for what it's worth. Um,
And I think there's statistics out there that talks about the market's up 60% of the time anyway.
sure, right.
So
Which putting it through the point is putting it through the lens of the election cycle doesn't change that.
yeah, it's the year of the election and the year before the election that really matter.
Right, right. So this is showing those actual years, the markets, each presidential election year going back to 1928, who won, Republican, Democrat, and what the returns were for the index in that given year. So you see there were only 4 years total where the market was down in that election year. 4 total over these, however many we have on the screen here. So I think that this is an interesting slide to just put it into perspective. Ultimately, it typically does not matter, who wins party-wise as far as what the market does. I did have a couple of points to share here. I want to bring this up. So I was recently in a session with a part of Schwab's political team. They have a team of 10 folks that are down on the Hill, and they do research with how politics affects markets, and they're actually down there, sort of getting the inside scoop. But there was a couple of things in particular that we thought were interesting. So, and I'm gonna start off here, and I'll go down the list. So, the market has risen in 13 consecutive election years when the incumbent was running for re-election. So anytime there's been an incumbent for the last 13 consecutive elections, the market was up. They were unable to find any pattern, any correlations for how the market reacts after an election. They look at this through the lens of, well, what if it's a Republican? What if it's a Democrat? No pattern there, as well as no real pattern as to like which sector may benefit or may not benefit based on it being an election year. However, they did find, and this is what I thought was interesting, is we're always asked, well, what happens if Trump wins? What happens if Biden wins? Or what happens if, the Republicans take control of the Senate or Democrats, we get asked that all the time. And what does that mean for the market? And ultimately, you really don't know. And we're going to talk about this a little bit. There are some correlations with parties and who controls which, Senate, House. There's a much greater correlation between what happens in the market and what it means for the election, which kind of makes sense because, right, the market is sort of somewhat of a predictor of where things are going. So I'll give you two stats here that are pretty compelling. So if there's been a recession in the previous 2 years, which right now, 2024, we're not in that camp. But if there's been a recession in the previous 2 years, the incumbent has lost all 6 times that has happened. So a recent recession is almost always a you're out of here for the incumbent, which makes sense. The other one, which I thought was interesting, is there's a very strong correlation. 20 of the last 24 elections, the performance of the S&P 500 in the last 3 months before the election. So I think we were talking, that'd be like, whatever, mid-August to mid-November, something like that, right? Whatever the market does, that has predicted 20 of the last 24 elections. So to put that a different way, let's say the market was up during that time frame, it would suggest that Biden's going to win because he's the incumbent. If the market is down during that time frame, it would suggest that Trump's going to win because he's the challenger. Not perfect, 20 of the last 24 election, but it was actually the most significant statistical correlation that they found between anything relating to market performance and elections. It was, how does the market do 3 months leading up to the election, and what does it say about who wins? So I thought that was interesting.
Yeah, so depending on whose side you are on, and your hope could be that the market goes up, or your hope can be that the market drops off. We do anticipate that, our anticipation from the beginning of the year, if I remember correctly, Dan, was we believe the market will be up this year, but we believe it'll be up in the single digits. If that theory plays out, where are we right now? Up 18%,
right,
on the S&P. But anyway, these are interesting statistics. I think you have some more coming up on the next slide too, which I thought were quite interesting here as well.
Yeah, I mean, this one, again, this is more, I guess, for what it's worth. This is not like there's a huge correlation between any of these. However, looking at the numbers, this is showing you essentially split Congress, right? Unified Congress and unified government. Typically, if we're looking at what is the best scenario for markets, and we've said this before in the past, typically and we're going to continue on the same trend of don't think about your political party or affiliation when investing. Typically, the market likes when there's a split, right? So unified government tends to be the least favorable outcome, just in total. So in other words, if you are a Trump voter and you say, well, if there's a Republican president, I also want the Republicans to take over the Senate and the House. I want just a complete red wave. Okay, well then, historically returns would be 12.9%. From a market standpoint, again, historically, it would actually be better if you go over to the left-hand side. If Congress was split and you had a Republican president and then the Democrats controlled the House, the market is typically up 13.7%. Same thing if you're a Biden voter and you say, well, I just want a complete blue wave. President, Senate, House, everything is Democrat, 9% typically is the return numbers. Well, go over to the left-hand side, split Congress, that goes up to 15.7%. So, I mean, typically the market likes to see um, partisan control one way or another, or I'm sorry, bipartisan control one way or another. It's again, this is not a perfect correlation, but generally speaking, over the long periods of time, usually the market is performing better during times of divided government. Uh,
which is the way it's supposed to be.
Yeah, well, and somebody put it this way. This isn't mine, but somebody said, well, that's just because they can't hurt you too much if they don't all control everything, right? Which there may or may not be some truth to that, but it's true that typically the market is up more when there is a divided government. One interesting stat is currently the Senate favors Republicans and the House favors Democrats. And the House and the Senate have never flipped in opposite directions in the same election, but they're I don't want to say they're predicting it, but it could happen this year. Never happened before. So again, not sure what that means for the markets, but just an interesting factoid. Probably good because the market likes divided government.
You've
One
come up
other
with a lot
thing.
of interesting factoids
Yeah, well,
today.
it's not mine, but I have it. So here's really the bottom line and why we bring up all of these kind of different charts here is going back, and this is 61, so I think the last 12 presidents. And we have another chart. It's not in this slide deck, but if you were to only invest if a Republican was in office, or if you were to only invest if a Democrat was in office, not a good investment thesis. Ultimately, the market grows over time. It does not matter who's in office. In fact, you can see whether it's red or blue, or red and then blue. There's periods of growth. There's periods of downturns, stagnation. There doesn't really seem to be any correlation between one or the other. And in fact, if you did only invest during one or the other, you would be much worse off than if you were to just stay invested regardless of who's in office. And at the end of the day, that's really the point that we're trying to make is who wins the election, whether it's an election year or not an election year. What matters more is what's happening in the economy, what's the Fed doing with interest rates, is inflation going away, is corporate America meeting its earnings targets, things of that nature, the things we typically talk about on these quarterly meetings, and really just sort of ignoring the political landscape as any means of an investment thesis.